What's up everybody, welcome to the channel. Soil here, and today I want to talk about the most important subject in trading, risk management. Without a proper risk management strategy, your losing trades will be out of control, and one or two losing trades are enough to wipe out all your profit or to completely destroy your account. So if you want to stay in the game and become a successful trader, you need to have a risk management strategy. I highly recommend you to watch this video until the end because it's really important to learn how to correctly protect your account. Without wasting any more time, let's get started. To become a successful trader in financial markets, before entering any single trade, you must know three things about the position that you want to take. First, you must exactly know at what price you want to buy the asset, in other words, to enter a trade. Second, you must exactly know at what price you want to sell the asset with profit. In other words, if the market goes the way you expected, how much profit you want to take. And third, you must exactly know at what price you want to sell the asset with loss, which means if the market goes the way you didn't expect, how much loss you're ready to accept. Amateur traders don't think about these important elements before entering a trade, and they just like gamblers enter a trade, and when their trade is in loss, they just wait and pray in the hope that the price is gonna rise, and all they want is to have their money back. And when their trade is in profit, they hold and wait for more profit and finally regret for not selling at the better price that they had. Actually, emotions kill their account, but professional traders don't behave like this. Before entering any single trade, they exactly know at what price they want to enter, at what price they want to take their profit, and at what price they want to close their trade with loss. By planning the trade before entering the trade, they don't allow the emotions to play any role in their trades. Successful traders plan the trade and trade the plan. Two of the main techniques that you can use for managing risk is stop loss and take profit orders. And by calculating these points before entering a trade and placing these orders immediately after entering the trade, you're actually planning your trades ahead and you're effectively managing the risk that is associated with your trades. Now you may ask what level of stop loss is considered optimal to have the minimum impact on your account in the case of losing trades, or what level of take profit is considered appropriate in relation to stop loss to make your account in profit in long run. We have a risk management method that is called 1% rule, and by using this technique, you only risk 1% of your account, so you keep your losses minimum. And by sticking to this rule, you can be sure that your loss is set to minimum amount in trades that the market goes against you. You're not gonna win every trade, and you will definitely have losing days. And by using the 1% rule, you protect your account from falling significantly. Let me give you an example to make it clear. If you lose half of your account in a single trade, it means that you need 100% gain to just get back to the point that you were. But if you use 1% rule and you lose 10 trades in a row, approximately you lose 10% of your account and you need 11% gain to break even. 10 losing trades in a row in practice never happens unless there is something critically wrong with your trading system and actually decision-making process, or very bad luck. Pay attention that while using 1% rule, losing 10% of your account can happen, but in months, which indicates that you must stop trading and reconsider your trading system and analytical process that you use for decision making to have a better winning rate. So you see that if you don't use 1% rule, you can easily destroy your account. That's actually why most of novice traders lose their account. When we say 1%, it doesn't mean that, for example, if you have $10,000 in your account, you must buy only $100 of the asset. You can buy the asset with all your available money or even borrowed money and leverage your position, but you set your risk management steps in a way that you don't lose more than 1% of your account. Let's see how we do it in practice by some examples. Consider you want to buy a share. Its current price, for example, is $50, and you think that this is a good price to buy, and you have $10,000 in your account. First, you calculate how much you're allowed to lose. By the 1% rule, you're allowed to lose $10,000 multiplied by 0.01, which equals $100. You can lose $100 on every single trade. Next, you must set your stop loss, and you should determine at which price level you want to sell your share if the market moved against you. Consider after analyzing the chart, you realize that, for example, $49 is a good level to set stop loss because you think that if the price hits this level, it will go even lower. Now you must calculate how much you lose for every share if the price hits the stop loss, which is the difference between the entry price and the stop loss. So it would be 50 minus 49, which equals $1. The maximum loss per share is $1. Now we calculate how many shares we must buy simply by dividing the maximum loss amount to the maximum loss per share. We divide 100 by 1, which equals 100 shares. So you must buy 100 shares, which costs you $5,000, half of your account. So with half of your account, you're buying shares, but if the market moves against you and hit your stop loss, you only lose $100, 1% of your account. I placed a link in the description of this video to a small and simple calculator that you can calculate the number of the asset units that you must buy simply by filling these fields. So here you enter your available balance in your account, here the risk level, which I recommend stick to 1%, here the entry price, the price that you are interested to buy the asset, and here the stop loss price. And simply by clicking on the calculate button, you can get the number of the asset units that you must buy to keep the loss limited to 1% of your account. Based on the asset you're buying, you may need to round down the decimal points of the number that you get. All right, when you're risking 1% of your account, on the other hand, you must also have a proper profit target based on the 1% risk by considering your winning rate to make your account profitable in long run. Actually, this is called risk to reward ratio, and you must have a proper ratio based on your winning rate. For example, risk to reward ratio of 1 to 1.5 means you risk $1 to make $1.5. Or risk to reward ratio of 1 to 2 means you risk $1 to make $2, and so on. It's generally said that you must have a risk to reward ratio of at least 1 to 1.5, but choosing the minimum ratio depends on your winning rate. For example, consider you have a winning rate of 50%, which means you win half of your trades, and by having a risk to reward ratio of 1.5 for 100 trades with your $100 account, you will have $50 loss and $75 profit. So in long run, your account will be in $25 profit. The more the risk to reward ratio, the better your account grow. But as I said, choosing the minimum ratio that you must always stick to it depends on your winning rates. The lower your winning rate, you need more risk to reward ratio to be profitable in long run. For example, if you have winning rate of 30%, you need at least risk to reward ratio of, for example, 1 to 3 to be profitable in long run, because in 100 trades with your $100 account, you will have $70 loss and $90 profit, and your account will be in $20 profit in long run. In this video, we continue with risk to reward ratio of at least 1 to 1.5 to explain the examples, but you must choose the minimum ratio of risk to reward based on your winning rate. So here, if the profit target that we want to set is in a way that makes the ratio less than 1.5, so it's not a good trade and we shouldn't enter that trade. In the example that we just discussed for 1% rule calculation, we are risking 1% of the account, which is $100. So if you have an opportunity to enter a trade which has a potential profit target of $150, so you enter. But if it's lower, for example, if you think that the profit target could be $120, so you don't enter because the ratio becomes lower than 1.5, and based on your winning rate, you will not be in profit in long run with these trades. Consider you analyze the chart and you think that the profit target could be somewhere in $51. Simply calculate the ratio for one share, which is take profit minus entry price divided by entry price minus stop loss, which gives the ratio of 1, and this indicates that this trade doesn't have proper risk to reward ratio for us and we shouldn't enter. But if, for example, you analyze the chart and based on your analysis you think that the price can rise to $52, this gives the ratio of 2, which tells us that this trade has a proper risk to reward ratio for us and we enter the trade. Now let's check another example to show you how you can use this 1% rule and also leveraging your account. Consider you have $10,000 available in your account and you want to trade Bitcoin. If we calculate 1%, it equals 100, which is the maximum amount of loss that we must consider for every trade. Bitcoin price is, for example, $40,000 and you want to place stop loss on $39,800. So the maximum loss per coin is equal to 40,000 minus 39,800, which is equal to $200. Now we divide 100 by 200, which equals 0.5. So you can buy half of Bitcoin, and if the market goes against you, you lose only $100. But half of Bitcoin is $20,000 and you only have $10,000. So with leverage ratio of 2 to 1, you can buy half of Bitcoin with your $10,000 if your broker allows, of course, and you're risking only $100, which is 1% of your account, not borrowed money. And one point that I must mention here, your entire stop loss order may not get filled at the price you want because of slippage that happens when the market is highly volatile, and this causes bigger loss than expected. So to keep the 1% rule, it makes sense to consider a little smaller number of the units of the asset that you calculate. Usually for accounts that are less than $100,000, 1% risk rule is commonly used, and sometimes when traders become consistently profitable, they may use 1.5% or 2% risk, but sticking to 1% rule is a safer option. And for accounts over $100,000, they may use 0.5% or even 0.1% for very larger account. Usually, as much as the account becomes larger, the less risk they use in the risk management system. Alright, that's it. Thank you for watching this video. If you have any question, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you found any value in this video, please like it. Please subscribe to my channel if you haven't already, and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.